Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, Jim, it must be Friday. We're together talking, and what an interesting week it's been.
Long-time listener Michael has a question for you. He says, hello, Bob and Jim. Those gold miners and silver are crashing. Bob, will the gold miners and silver double bottom at those March 2020 lows? Is this precious metal selling all about raising liquidity? No one seems to be selling Bitcoin for liquidity, and stocks are still near record highs.
Yeah, Michael, good observation on the gold miners. We had noticed that a year ago in July, and it had been long to trade, but our technicals just went excessive on it. And the advice in the golds was to both traders and investors to take some money off the gambling table. And then for the last number of months, we've been thinking that perhaps the next buying opportunity that could occur sometime maybe October, November, as probably the big New York market heads into a liquidity problem. And actually, this is ironical because silver is getting killed relative to gold. The gold-silver ratio is moving up. We had been plotting that since earlier, a while ago, where it looked like it was going to build a base, and the base in the gold-silver ratio completed when it rose above the 20-week exponential moving average. And then the next step was to get above the last high, which was the 73 level, and now it's up to 77. So this is breakaway stuff. The guys in the silver game are getting killed, but it happens. We use it as, call it the metallic credit spread, because the ratio goes down in a boom, like credit spread narrowing, and then the ratio goes up in a bust. And indeed, in rising, or in this case, building a base and then rising, has been anticipating a financial problem being discovered in the fall. Now, Michael, your question includes about maybe a double bottom at the March 2020 lows. You can't really say that ahead of time. We're just going to wait until our technicals come in and say that this is really oversold. And we've got two things going there. One is we call it a downside capitulation, when it gets really whacked down to, lows. And then that's based on momentum. And then there's another system that is based upon pattern. And at a bottom, it can give a sequential, what we call a sequential buy. So we have a couple of tools that we can use when the next buying opportunity comes in, and just guessing, maybe November sometime, but, just guessing. But we will be there when the time comes, and just the same as we were at the buy for the precious metal sector ours came in November 2018. And then, as I said, last July, way overbought, and it was time to take some money off the table. So, yeah, thanks for the question.
My question, Bob, is why do most corrections in the stock market happen in the fall?
Oh, boy, I've been thinking about that a long time. And there's sort of a seasonality in interest rates where credit spreads can narrow into around May or June and then turn to widening. And then industrial commodity prices such as copper can have a high in July and then have a seasonal low. So there's a lot of seasonal forces at play that add up to providing sometimes wonderful rallies into the middle of the year, which we have been working on. And then August was to be the transition from boom to contraction, and it is happening. I mean, the credit spreads have reversed to widening. Industrial commodities no longer going up. And, as we say, we use the gold-silver ratio as a guide to boom or bust, and it has been warning of a bust for a couple of months now. So, as to why does the Earth rotate on a 24-hour basis? It does. That's all you need to know. And to explain why gets you into some really weird stuff. So we just look at the way things happen.
Well, I think we had a little discussion not too long ago about why the fall, and we speculated perhaps traditionally it was because farmers kind of sold their expected harvest on spec, and if they had a bad harvest, they couldn't pay back their investors, and that would lead to a crash.
Oh, yeah, that was part of the thing where, farmers borrow money in the spring to seed their crops and get the cash in the fall when they come in the harvest in. But it's whatever it is built in. I saw one doing historical work for the book, and there was a financial distress in London in the early 1600s, and I noticed that there were the people reacting to the distress in that October and November. We know that in the huge mortgage crash in, like, northern Italy, Florence, in 1347, for a couple of years, and there's a book written by historian Cipolla, very good. Details like you wouldn't believe. But anyways, their worst periods in liquidating that problem of the mortgage market occurred in the fall. And I haven't been able to find any comments back in Roman times about a disaster occurring in the fall, but hey, who knows? But so it's one of those things. Sell in May and go away. Then you want to have the liquidity, the nerve, and the advice to re-enter the market when it's a disaster. And this is what, again, with our systems, at times, Jim, I've called it, well, you're in a crashing market in the fall, and it's like trying to catch a falling knife. But with proper technical tools, it'll help you catch that falling knife without doing serious damage. So, can't explain why. You just look at how things happen and write it up. So
we'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob's going to discuss some headlines that he took a look at this morning. The first one, China auto sales tumble for third straight month. Is that a good barometer of what's happening with the Chinese economy right now?
Yeah, I think it's slowing, and the other thing that we've been talking about, Jim, with China is that the government authorities, of course, always want to look in charge of what's happening. So they've been beating up on all kinds of companies or industries and stuff like that, which I think is they're already in the contraction. So they're now beating them up and looking like they're in control. But it's going to be fascinating to see how China goes, because it's still an authoritarian government out of Beijing, but they have all become filthy capitalists and probably have got all kinds of money stashed away in hidden accounts and stuff like that. So on one side, they have a vested interest in the boom continuing. On the other side, they want to look like they're in control. So it's going to be fascinating to see how it comes out. So, yeah, particularly. Oh, yes, indeed. It's going to be fun to watch.
U.S. consumer sentiment at decade low.
Yeah, I was surprised at that one. But maybe troubles and the whole thing, but it was just a strange number. It just came out that way. And yet, financial markets have been so positive.
Well, as they say, there's Wall Street and then the real economy.
Yeah.
And Tim Wood has pointed out for us several times how there's actually been a big disconnect for about the last 10 years between what's been happening on Wall Street and what's been happening on Main Street.
Yeah.
You know, so many millions of people have given up looking for work and have become permanent, either off the grid, people surviving however they can, probably at the point of a gun, and then those who have invested well and are doing terrifically well.
Yeah, it's quite diverse. The way I've been looking at it, Jim, is that 2021 was likely the year where a great bubble could complete. And for that to complete, you had to have terrific speculation, absolutely mind-boggling speculation, which we have had. But then you got to go back a year or so when they came in with all the lockdowns, which was extraordinary. This is just out of the blue. And it even did, for a while, they did call it a recession, but there was still the boom going on that had to complete. And as we noted in January, more than likely the best would be in by mid-year, and that August would begin to see the change. This is working out. So, and then you've got these huge cross currents, and that I wrote the headline down, and it's a while since I wrote it down and read the article, but sentiment was low. And at the same time, anybody in here close to the stock market is in a world of euphoria. So, but this can change. As I say, the key elements in the bull market, credit spreads, industrial commodities, have been changing to suggesting a contraction. And also it's on the right timing. So when a contraction comes along and these major liquidity problems have always or usually been found in the fall of the year. Yeah.
Wall Street bullishness is at a peak it hasn't seen in 2 decades.
Yeah, this one, Jim, was based upon that they did a survey and 56% of recommendations are buys. And that goes back to the dot-com bubble in 2000, where maybe at times the percentage of recommendations of buys were higher. But it was enough that when the crash came in, there were government hearings into it. But one of the problems was it was at the advisory level, research level, the talking heads on television and stuff like that were just universally bullish. And this also worked where you had the underwriting department's coming out with many new stock issues. So, of course, then the research department were bullish on what the underwriting department was coming up with. So it became all rather stinky. And then they had these hearings, and the point was, how could so many professionals be so bullish, so adamantly bullish at the top of the market? But that's the way it worked. But this then gave quite a boost to independent research, where you were outside of that big broker, big investment dealer loop. And we did very, very well. We expanded our business nicely on that one with, as they called it, independent research. So, it's interesting that people put the numbers to it, and we'll see. Again, this, I think, is going to be another widespread embarrassment.
The specter of inflation stalks debate on the $3.5 trillion U.S. spending bill. Yeah,
that one is really in the commodities were likely, industrial commodities were likely to rally into mid-year. And we based that one on that the great bubble would likely complete in mid-year, and that there would be a really good business activity with it. So in previous great financial bubbles, and the best way, one of the ways of looking at it is through copper's real price as deflated by the CPI. And copper in the last year or so had a really terrific rally in real terms. And then the other one with gold's real price as adjusted by inflation, which reached a huge overbought a year ago in July, it's been coming down. And as I point out, where you've got the history of copper, I think we got it back to about 1830. But the observations were that in the final stages of a great bubble, copper's real price goes up and gold's real price goes down, and which we have had. Now, gold's real price is starting to go up, and of course, maybe in the next month we'll suddenly discover that copper's real price is heading down. And then when in a post-bubble contraction, gold's real price continues to go up, and the real price for industrial commodities goes down. So this is where I'm getting to, Jim, is that where people who have not done enough research are seeing right now the recipe for runaway price inflation like the 1970s, and where government would expand credit hugely, the dollar would go down, and you had to crank in the inflation premium, so the CPI went up. But in many ways, I can point out that the really big action is still in financial assets, and that in previous great manias in financial assets, such as 1929 or 1873, or going back to 1825, once the game of inflation and financial assets was over, the contraction was so severe that prices for most assets went down. So we're staying with the view that those who are calling for inflation haven't done enough research, and our research suggests that we're going to go into a post-bubble contraction where the prices of most assets will go down, and this is where it gets interesting, Jim, because they'll fall relative to gold. So when you've got gold's real price going up, as has happened in previous post-bubble conditions, that improves the profitability of gold miners, and you have a real and multi-year bull market for gold mining in a post-bubble deflation. So Hey, it's crazy, but the research is there and the history is there, and this is why the next entry point for the gold sector is going to be a terrific opportunity when you get in on this one, because then it'll be a multi-year bull market for gold stocks where they will likely outperform the S&P. And this also gets more interesting, Jim, because you've got many fund managers out there that would not ordinarily buy gold stocks. But if you got quarter after quarter of the gold stocks outperforming the S&P, those fund managers are going to have to get long gold stocks, which then adds to the excitement on the way up. So looking very good ahead, Jim, but we're cautious on the short term.
U.S. housing construction has slumped 7%. What's the story there, Bob?
Yeah, I guess that was tied to the peak in lumber price at over $1,700. I think it was about May the 10th or something like that. And then we also, well, by the way, that rally was so horrendous, as you pointed out. It started at 275 in March 2020. The excesses on the upside were terrific. And we played that one against a possible seasonal high in June. Hey, May the 10th, close enough. And then it got hit. Now, also, there is a housing index representing the housing industry, and it set a high virtually on the same day as lumber. And while not falling like lumber's fallen to 500 or something like that, this has been hit, but not yet breaking down. So then what you have with this number about housing starts down, this was already being told by the sharp decline in lumber prices. And so this is all adding up to a great top, probably completed. And the key thing, Jim, was in August we expected the financial items to begin to change and head towards a contraction, and it looks like this is on the path.
Bob, thank you so much for chatting with us.
Well, Jim, look forward to next week, and we look forward to all them questions coming in.
And if you have questions for Bob, you can send them to info@HoweStreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.